There is a moment in every financial system when confidence quietly replaces caution. It doesn't happen overnight. It doesn't happen loudly. It happens gradually when stability lasts just long enough for fear to fade. After years without a major collapse, markets begin to behave differently. Risk stops feeling dangerous. Leverage stops feeling reckless. Warnings start sounding theoretical. And eventually, the system forgets why the rules existed in the first place. This is how financial bubbles are born, not from ignorance but from belief. Belief that the system has evolved. Belief that technology has solved volatility. Belief that institutions are stronger, smarter, more prepared than before. By the late 2010s, this belief had fully returned. Markets had survived a global financial crisis. They had survived a sovereign debt scare. They had survived a pandemic. Each time, intervention arrived. Each time, collapse was avoided. And with every rescue, confidence grew. Investors began to assume that instability was no longer fatal, only inconvenient. That assumption changed everything. Leverage quietly increased across markets. Corporations borrowed not to survive but to optimize. Governments borrowed not to invest but to sustain. Investors borrowed not to hedge but to amplify returns. Debt became normal. Then it became necessary. Then it became invisible. One of the most dangerous shifts occurred in how markets understood liquidity. Liquidity is the ability to sell without moving the price. In good times, liquidity feels infinite. Assets trade smoothly. Buyers appear instantly. Markets feel deep and resilient. But liquidity is not a permanent feature. It is a condition, and it exists only as long as confidence holds. Modern markets are built on the assumption that liquidity will always be there, provided by algorithms, funds, and interconnected institutions. But those systems don't provide liquidity in stress. They demand it. When volatility rises, algorithms step back. When prices fall, margin calls accelerate. When fear spreads, everyone tries to exit at once. That's when liquidity disappears, not gradually, but suddenly. And when liquidity vanishes, leverage turns lethal. This is the moment where confidence cracks. Not because something catastrophic has already happened, but because markets realize something terrifying. There may be no buyer on the other side. This realization has repeated itself throughout history. In 1929, in 1987, in 1998, in 2008. Different triggers. Same mechanism. Confidence breaks, leverage unwinds, and the system scrambles to survive. But the modern system introduced something new. Speed. Markets no longer react over days or weeks. They react in milliseconds. Prices adjust before humans can think. Losses cascade before risk managers can respond. Feedback loops amplify small shocks into system-wide stress, and the faster markets become, the less time there is to intervene. This is why the next crisis won't look like the last one. It won't unfold slowly, it will erupt. The danger isn't a single bad asset, it's correlation. When everything is connected, diversification becomes an illusion. Assets that appear unrelated begin to move together. Losses compound instead of offset. Hedging strategies fail when they're needed most. The system doesn't bend, it snaps. And this is where psychology becomes as important as economics. Because markets are not just numbers, they are beliefs. Beliefs about safety, beliefs about control, beliefs about rescue. For years, investors learned that central banks would step in. They learned that governments would act. They learned that institutions deemed systemic would not be allowed to fail. This belief reduced fear, and reduced fear encouraged risk. But there is a limit to intervention. Central banks can provide liquidity, not solvency. Governments can stabilize markets, not erase losses. When confidence breaks at scale, intervention becomes harder, slower, less effective. Because expectations have grown faster than the tools designed to manage them. This creates a dangerous gap. A gap between what markets expect and what authorities can realistically deliver. That gap is where crises are born. The most unsettling part is that the system doesn't need a dramatic trigger. It doesn't require fraud. It doesn't require a collapse in fundamentals. It doesn't require malicious intent. All it needs is a moment where participants realize they all want the same thing at the same time: to get out. And when everyone wants to exit simultaneously, the system reveals its true shape. Not a stable machine, but a fragile network held together by trust. Trust in pricing, trust in liquidity, trust in intervention. Once that trust fractures, it spreads. Banks pull back from lending, funds gate withdrawals, markets gap down instead of adjusting smoothly. And suddenly, the confidence that fueled growth becomes the force that accelerates collapse. This is why warnings are so often ignored. Because the system works until it doesn't. Because stability feels permanent until it vanishes. Because risk doesn't announce itself loudly. It whispers. In stretched valuations, in growing leverage, in markets that no longer react to bad news. By the time the warning signs become obvious, options are limited. And history shows us something uncomfortable. Crises rarely arrive from where people are looking. They arrive from the margins, from structures assumed to be safe, from markets assumed to be liquid, from systems assumed to be controlled. And when they arrive, they move faster than anyone expects. The question is no longer whether confidence will be tested again. It's what happens when it is. Because confidence, once broken, is far harder to restore than it is to lose. And when it disappears, the system doesn't ask for permission to unwind. It simply does. What comes next will determine whether the modern financial system can survive without rewriting its foundations. Because the next phase isn't about growth, it's about resilience. And the cracks are already visible, if you know where to look. Welcome to Cash and Chronicles, where money, power, and history collide.